The day I started investing, I faced this question. Should I invest in stocks or mutual funds? I'm sure there are a lot of new investors who face the same question. So which option is better? Stocks or mutual funds? Well, honestly speaking, there is no fixed answer. Both stocks and mutual fund have their own set of pros and cons. For example, while stocks have high return potential than mutual fund balances the risk better than stocks. So in this video, I have tried to compare both stocks and mutual fund with their pros and cons. At the end of the video, I have concluded which option is better. Then there is another common question. How many stocks or mutual fund you should hold in your portfolio? Hello friends, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. I recently conducted a poll and asked, where do you invest your money between stocks versus mutual fund? And 60% people said that they invest in both stocks and mutual fund. This clearly suggests that people understand the importance of both stocks and mutual fund. However, in this video, we'll try to figure out the pros and cons of both investment options. We'll first understand the difference between stock and mutual fund and then identify the pros and cons of both styles of investment and finally conclude which option is better. And friends, mutual funds are itself very vast. You have active versus passive mutual fund, equity versus debt mutual fund, sectorial mutual fund, direct versus regular mutual fund, and so on. So if you want to learn in detail about mutual funds, along with how to pick stocks, how to pick insurance, how to do tax planning, etc., I have curated a complete course for you. Details are in the description. Alright, let's get started. So the basic difference between equity mutual fund and stock is that when you invest in a particular stock, you take the ownership in a particular company. For example, if today you buy a share of HDFC Bank, you take a small ownership in the company. For example, if one share of HDFC Bank is let's say rupees 1500, you need to shell out rupees 1500 to get one share. You can't invest rupees 750 to get 0.5 share. But when you invest in a particular equity mutual fund, you take the ownership in multiple companies. Although this ownership is not direct, it is indirect. For example, let's say you invest in a large cap mutual fund that has 50 stocks in the portfolio. In that case, you will have indirect ownership in 50 companies. It means even if you invest rupees 500, you would still have ownership in 50 companies. So let's say out of 50 stocks, TCS has 10% weightage in the overall portfolio. In that case, out of rupees 500, 10% would be invested in TCS. But here you don't hold the direct ownership. You buy the mutual fund units and not the stocks directly. Now let's understand the pros and cons of both investment style. The benefit with stock investment is that you are the decision maker of the stock buy or sell. Whereas in mutual fund, you can't decide which stock to buy or sell. So with stocks, you have the direct control on your investment. If today you like Asian Paints, you can buy it. Tomorrow if you want, you can sell the shares of Asian Paints. But with mutual fund, your fund manager would decide which stock to buy or sell in the portfolio. The benefit of stock investment is that you hold the direct ownership in the company. Whereas the disadvantage with mutual fund is that you can't hold the direct ownership. For example, when you buy stocks, you own them. But when you buy the mutual fund, you own the unit of mutual fund and not the direct stock. Next, in individual stock, there is high return potential. Whereas in mutual fund, you can't expect multi-bagger returns. For example, if today you invest in Polycab, then you can expect maybe around 10 times return in next 10 years. But if you invest in mutual fund, you can't expect 10 times return in 10 years. It is simply because of the fact that in mutual fund, there are multiple stocks and hence if a particular stock rise, there would be another stock that would fall and that would average out the returns. However, the disadvantage with individual stock is that it is a high risk game and there is no diversification. But with mutual fund, you reduce your risk due to diversification. For example, if today you think that pharma sector is rising and you invest in a specific pharma company and if tomorrow due to any reason the company fall, then you will face loss. However, with mutual fund, you can invest across companies, across sectors. For example, it could include your pharma, IT, banking, FMCG, etc. So if pharma sector falls, maybe banking sector could rise. There have been cases where a lot of investors lost money in stock market by investing in wrong companies. So there is high risk with stocks, and with mutual fund, your risk would reduce due to diversification. Next, in stock, you need to do your own research. It requires a lot of time and energy. But with mutual fund, it is fund manager's headache. So if you're someone who has a job or business, it is difficult to keep a track of each stock performance. However, with mutual fund, you can just invest and relax. Next, in stock, systematic investment in stock is very difficult, whereas with mutual fund, it is very easy. The most difficult decision with stock investment is, should you buy if a stock is at overvalued state? For example, let's say you invested in Affle India last month. Now today, you got your salary and you want to invest more money. But Affle India has become overvalued. Now will you invest? Majority of people would not have the courage to invest at higher level. So they would keep waiting for the stock price to fall. In that case, sometimes they lose the opportunity to invest. Whereas with mutual fund, you can set up an SIP. So every month, a specific amount would be invested in that fund. And it would be fund manager's headache to identify the undervalued stock and rebalance your portfolio. Here we are talking about active mutual fund. We are not even talking about index fund. That is a different discussion altogether. Now in stock, you don't need to pay any fee. Whereas in mutual fund, you need to pay a fee, that is expense ratio. Again, a big differentiator. When you buy or sell stock, and I'm assuming that you invest with zero brokerage companies, you don't need to pay any money as commission. Of course, there are some transaction related charges, but they are minimum. However, when you invest via mutual fund, you end up paying an expense ratio somewhere in the range of around 1% when you opt for direct plan. Although this expense ratio would vary from mutual fund to mutual fund. And of course, if you take index fund, then the expense ratio is very less. So for example, if your investment value is rupees 5 lakh and your average expense ratio with mutual fund is 1%, then you will end up paying rupees 5,000 as fee. Next year, if your investment value is rupees 10 lakh, then you will end up paying rupees 10,000 as fee, and likewise. In stock, even if the market is overvalued, you can identify undervalued stocks. In mutual fund, if the market is overvalued, you would end up investing at overvalued levels. For example, currently Sensex is at the level of 50,000. Now majority of stocks are at overvalued state at current levels. If you invest via mutual fund, you would end up investing in those overvalued stocks as well. However, with individual stocks, you can still identify stocks that are not overvalued. Of course, it is a very difficult task to identify those undervalued stocks. Next, you can't reduce your tax liability with stock, but you can reduce your tax liability with mutual funds. With mutual funds, you can reduce your tax liability up to rupees 1.5 lakh by investing in ELSS mutual fund under section 80C. So the question is, should you invest in stock or mutual fund? Now there is no fixed answer to this question. Both mutual funds and stock have their own set of pros and cons. At the end of the day, it depends upon your risk versus return profile. Individual stocks are very high risk and high reward game. There are many stocks that have created wealth for the investor. However, at the same time, there are wealth destroyers. The most important thing in stock investment is to spend time and energy to do the research and identify the right stocks and then keep a track of their performance. But if you are someone who has a job or business and does not have the time and energy for research, then mutual funds are a better solution. So I personally invest in both stocks and mutual funds. I have a fixed SIP that is for the long term, and I also invest in stocks. That way I diversify my investment. Next question is, how many stocks and mutual fund should you hold in your portfolio? Well, there is no fixed number. Now you can hold as much as you can track. But generally speaking, 6 to 8 mutual funds are good enough for a balanced portfolio. And in case of stocks, somewhere around 15 to 20 stocks can be good enough. By the way, some of you might be confused about what is a small case and if small case is better than mutual funds or not. So I have created a separate video on small case versus mutual funds. I would strongly recommend watching it. So in this video, we discuss the pros and cons of mutual fund versus stock market. I hope this video will help you compare both the options and decide the best investment option. So how do you invest your money? Do let me know in the comments. And it's been a while since I have given these shoutouts. So first of all, thank you so much for your love and support. It's been amazing to see such great comments. I want to highlight a few of them. Mr. Preetham Tekriwal says that it scares me to think how much knowledge you must be having when you can share so much knowledge in just 20 minutes. Thank you so much, Preetham. It is because my entire day is spent on researching about the companies and its future. But now I also have a team to help me with research and other stuff. The goal is to empower each one of you with solid research so that you can make an informed financial decision. Next, Naitik Vora says that I have watched many videos on YouTube, but iska level hi alag hai. Thank you, Naitik. It is because I am deeply passionate about finance and investment. Next comment is from P. Roll, and he says that I always look forward to your videos. Really appreciate your detailed analysis of whichever video you make. Thank you, P. Roll, for your kind words. Next comment is from Bhanu Chakravarti. He commented on one of my recent video on stock fundamental analysis and said, your analysis has come. From tomorrow, the stock price would gallop forward. You have too many fans. Well, thank you so much, Mr. Bhanu. But honestly speaking, if a stock price shoot up after the analysis, then it would be only a coincidence, as my analysis is only for long-term investment based on fundamentals of the company. Next message is from Bhavesh Chedda. He says, excellent dedication and enthusiasm in stock analysis. Thank you so much, Bhavesh. Next, Mohan Raj says, world-class analysis. Thank you, Mohan. Next, Yadgiri Srinivas Rao commented that it is worth undergoing his Personal Finance Academy classes. This way, your thoughts will be aligned to get better conviction on your investment. Well, thank you so much, Srinivas, for your honest feedback. There are already 3,000 plus enrollments in the course and a lot of people are finding it very useful. There is a big problem of financial education in our country and I am trying to fill the gap. I wish I could give more shoutouts, but I would include them in the future. I will see you with another video. Till then, take care.